And it's another week on Business Morning. Good morning and thank you for joining us. I'm Ladi Williams.
And I'm Chimeze Obi Iwagu. Well, a couple of data and reports were released last week. Let's check them out. Data from National Bureau of Statistics shows Nigeria's debt servicing costs increased quarter on quarter by 88.8% to 803.69 billion naira in the third quarter of 2020 from 425.7 billion naira in the second quarter of 2020. The debt service fee comprised of the actual external debt service fee of 199.5 billion naira and the actual domestic debt service fee of 604.19 billion naira. Now, there was a rise in external debt service fees by 77% quarter on quarter. It rose to 199.5 billion naira in the third quarter from 112.9 billion naira in the second quarter. On the other hand, the domestic debt service fee rose by 93% to 604.19 billion naira in the third quarter from 312.8 billion naira in the second quarter, which was used to service debt, domestic debt of 20.04 trillion naira in the quarter. And Fitch Ratings in its report titled Nigeria's Deficit Monetization May Raise Macro Stability Risks noted that sustained use of direct monetary financing could raise risks to macroeconomic stability given the current weak institutional safeguards, but expects the federal government to reduce the use of the facility in 2021. It further noted that the federal government directly borrowed 1.9% of GDP from the CBN to fund its fiscal deficit in 2020, estimated by Fitch at 3.6% of GDP.
And in the meantime, a total of 619.34 billion was allocated for December 2020 to the three tiers of government. A breakdown of the allocation reveals that the federal government received 218.3 billion naira and states received 178.28 billion naira. Local government councils received 131.79 billion naira, while the oil-producing states received 31.83 billion naira as a 13% derivation of mineral revenue. And data from the Nigerian Communications Commission shows that a number of active telephone subscribers across the country rose to 208 million as of November 2020. The Central Bank of Nigeria last week, under the Anchor Borrowers Program, released about 300,000 metric tons of maize into the Nigerian market. This move by the CBN is expected to crash the price of maize from the current price of 155,000 naira per metric ton to around 120,000 naira per metric ton. And while the central bank has instructed that all exporters with unrepatriated export proceeds should be barred from accessing all banking services by 31st of January 2021. Affected exporters are therefore expected to comply with this directive before the specified date.
Okay, let's check with the global oil market this morning. Oil prices slipped for a second straight session this morning as renewed COVID-19 lockdowns raised fresh concerns about global fuel demand. Brent crude futures for March fell 15 cents to $55.26 a barrel, while U.S. West Texas Intermediate crude for March was at $52.19 a barrel, down 8 cents. China reported a climb in new COVID-19 cases this Monday, casting a pall over demand prospects in the world's largest energy consumer, the main pillar of strength for global oil consumption. Now, last Friday, prices came under further pressure after data from the U.S. Energy Information Administration showed U.S. crude inventories surprisingly rose by 4.4 million barrels in the week to January 15 versus expectations for a draw of 1.2 million barrels. Now, some support for prices has come in recent weeks from additional production cuts from the world's top exporter Saudi Arabia, but investors are watching for a resumption of talks between the United States and Iran on a nuclear accord, which could see Washington lifting sanctions on Tehran's oil exports and boosting supply.
And back here, the Monetary Policy Committee of the Central Bank has begun its rate-setting meeting. The first in the new year, and amid the rising inflation, liquidity squeeze in foreign exchange markets, and a poor growth trajectory. Nigerian economy slipped into recession in the third quarter of 2020 after the GDP contracted for a second consecutive quarter by about 3.62%. Many economic analysts believe that this was better than was expected. The federal government sounded very optimistic that Nigeria will be out of a recession by the first quarter of 2021. Here's what the central bank governor said at the last monetary policy meeting in 2020 in the prospects of exiting the recession.
Or contraction in growth, in output, is what we have seen throughout the entire world as a result not only of drop in commodity prices, but because of the adverse consequences of the health crisis created by COVID-19. In some developed countries, during the first, second, and even the third quarter, we saw some of them even showing double-digit contraction in growth. But in Nigeria, what we've seen, during the second quarter, we saw a minus 6.1% contraction, and I will use pleasantly in third quarter, a reduction in output to 3.6% negative during the third quarter. Let me say that we are hopeful, and the Minister of Finance had addressed some gathering yesterday where she said that she's hopeful that during the first quarter of 2021, Nigeria will exit recession. Based on data available to the MPC from the CBN, we are somewhat cautiously optimistic that indeed, if we continue doing what we're doing and do more, that there's a likelihood that we will see some little positive output numbers during the fourth quarter of 2020. But I can say with some level of certainty as well that we are so certain that during the first quarter of 2021, we will exit the recession. Why? As a result of all the actions taken by the monetary and fiscal authorities, NBS, National Bureau of Statistics numbers shows that 18 sectors during the third quarter recorded growth relative to 13 sectors during the second quarter. And this growth were recorded mainly from the agricultural sector, industry, manufacturing. Indeed, we saw even services dropping somewhat slightly. But I think agriculture coming on very strongly also means that what we can achieve from whatever we're doing to stimulate agriculture and manufacturing will create jobs for our people and also stimulate spending, will increase output, and ultimately lead to a moderation in the level of inflation in our country. And indeed, I heard some analysts talking about the parallel market, saying that exchange rate is at 480. I want to say this, that it is unfortunate and really unfair that even analysts who are supposed to know will play with numbers and begin to determine the exchange rate of our currency using parallel market rates. For the information of everybody, parallel market, as far as we know it and the data that we have, is a shallow market in Nigeria with no more than 5% of market share. Parallel market, and quote me, is a tainted market in Nigeria where people who desire to deal in illegal foreign exchange transactions, including sourcing of FX cash for purposes of offering bribes, corruption, that is where they deal. And that is where people who are supposed to understand the implication of this on the economic activity on our country begin to go to television and begin to say that our exchange rate is 480. This is very unfortunate that this is the way those who are supposed to know try to bend numbers in this country.
That was the Central Bank Governor, Mr. Godwin Emefiele. Well, monetary policy in 2020 remained broadly accommodative. The MPR was reduced twice in its May meeting and its September meeting. The CRR was hiked in its January 2020 meeting. In 2020, the MPR was slashed by 200 basis points to 11.5%, and the asymmetric corridor around the MPR was reversed to plus 100 minus 700 basis points. The cash reserves ratio was hiked to 27.5%, while the liquidity ratio was retained at 30%. Well, as the committee meeting for the first time in the new year, all eyes are on them to see what the monetary policy environment will look like in the next 2 months, and how determined they are to soar growth. Now, joining us now is a developmental economist, Professor Ken Ife. Professor Ife joins us from our Abuja studio. Thank you very much for joining us, Professor Ife.
Oh, thank you for having me.
So, can you please tell us what you think the central bank has done lately in keeping with its primary mandate of maintaining price stability in Nigeria, especially now that headline inflation is at 15.75% and food inflation at approximately 20%?
Well, first of all, just bear in mind, keep it at the back of your mind, that financial system stability, price stability, are two core functions of CBN. Of course, there is a secondary mandate, which is promoting sustainable economic development, and that's where you see forceful domestic finance intervention. And that said, if you want to go to the narrower end of the price stability, what I have to say to you, just bear in mind that we are in stagflation, a different kind of recession, described as stagflation, where all things that are supposed to be trending down, like interest rate and inflation, they're all supposed to be trending down because investors are pulling back from investing, and government is expected to augment, and expansionary policy is expected to come in to prevent a heavy, much more heavier losses and contraction. So in this circumstance, just bear that in mind. I can say that the bank is deploying all possible tools to ensure that they can maintain a reasonable inflation rate. And let me tell you why the challenges. We have severe challenges in inflation, in price stability. One is there are so many forces. You have demand pull inflation, you have supply push inflation, all of them operating on the domestic arena. And of course, you have some degree of imported inflation because of the situation on the forex. People using alternative means to procure currency and bring things and pass through the high prices to the consumers. Now, there are other things that are playing in this. When you look at the inflation itself, at the moment it's just over 15% for the CPI, the Composite Price Index, which is the headline inflation. But there are three other areas you have to look at. If you look at the core inflation, which excludes food sub-basket, is about 11, just over 11. And then the actual food sub-index is 19.7, almost 20. So the distance between the two tells you the role being played by farm produce. Farm produce is the difference, because when you look at food, you have farm produce and processed food. Processed food is a common denominator in core inflation, but then it shows farm produce is the real culprit. Why is it a problem controlling that? What's the challenge there? Now, CBN has invested massively, over 2 trillion over the last 2 years on domestic finance intervention, targeting term value chains, just to make sure that they can put money in dealing with asymmetries in the food section, and also de-risking the agriculture lending, because that is also one of the problems. And over $22 billion a year goes in importing all kinds of food-related things, which we can produce in the country. So you can understand why it's pouring resources to make sure that we can augment. And if you didn't do that, in March last year when COVID came, and many of the countries that were exporting rice, and India exporting active or certain ingredients, stopped exporting, we would have been in serious trouble as a country if we were dependent on imports. So we didn't have that option and luxury. Now, so while that is going on, if you look at the terrain of food, first of all, you have war going on in 6 different geopolitical zones, all kinds of conflict. All of them are impacting on food, be it Boko Haram, be it the kidnapping and the banditry. All of them are impacting on food, shrinking the agroecological footprint in the country. Now, CBN has responded forcefully by bringing in mechanization of agriculture, and then also more land clearing, in addition to just to make sure that we are, even within the existing footprint, we can increase productivity. And the level of intervention in agriculture is end-to-end, which means all the way from clearing to mechanization to seed control and fertilizer, herbicides, insecticides, all the way to production and market. So it's end-to-end intervention. And we never had this kind of level of intervention. So what it's doing is doing what it could to change the narrative on food. But there are other hostages. You have flooding coming in. You have what we call ECOWAS free movement. Now, our free movement protocol says every primary food, every primary products produced within the region should move around in the region without tax or duty. Now, you cannot rewrite that policy. And in fact, it's even the same in the AFCTA. Now, you can't stop the food moving from one country to another. And these are primary food. But if we have value addition, spread processing to world level, then it can keep the job here rather than export them. But to say that you're going to stop them from exporting is not possible. And we've seen some examples of what happened when we did border closure. So it's very, very tough. The thing that agriculture is doing is very, very tough. When they take the food to the northern parts like Niger and Mali, and they will process them, they will dry them. 5 months later, they will bring them back for us to buy at about 50% or more of the price.
Okay, Professor.
So in both respects, you see demand pull inflation taking off, and then you see supply push inflation coming back. So all of them are acting on food.
Yeah.
So it's a very, very challenging task for CBN to maintain, but they are doing their very best. Yeah. And all of us have to play our own part in this process.
All right, Professor, thank you for
but as to the other areas,
explanation. Hello, Professor, can you hear me?
I can hear you.
Okay, but looking at the trend of inflation, can you please tell us where the central bank has got it wrong and what you recommend and suggest that they can do differently to address these problems?
Well, now, it hasn't even done anything wrong. But let me tell you, the study of inflation, you have to take it back to 2017 when we did the Economic Recovery and Growth Plan. And the idea was that some of the recommendations of the plan was we want the fiscal authority to rebalance the external and domestic debt. We also wanted them to exit as much as possible from the use of the treasury bill to crowd out private sector investment. Now look at how that has happened. That has now come down from 18%, the yield, down to 1% for all three classes of treasury bills, 90 days, 180 days, and 1 year. Now that has also brought down more liquidity. Of course, that brought more liquidity to the private sector. And there was also other action by exiting private sector from open market, CBN open market operation, also brought additional liquidity to the private sector, although some of those liquidity found their way to the capital market, which was why we came out ranking the best in the country. But all of them are preparing the grounds for a regime of lower interest rates. And having said that, the bank also followed through by bringing down from 14% to 13% to 12.5% to 11.5% the prime MPR rate. But it didn't rest there. It also had to go to the private banks and try to use other instruments to get the banks to weed them off the treasury bill and then also make them bring more resources to the private sector. And that's where you saw the differentiated cash reserve ratio, where it was telling the banks, come and borrow the money that you have with me here and lend to the real sector. Then you have also the loan to deposit ratio, which it has to raise to squeeze the incentive that the banks have so that's why it increased from 55% to 65%. So all of these are pushing almost 5 trillion into the private sector. So there's more money going into the private sector because in the end of the day, the way you fight inflation is to increase capacity, domestic manufacturing capacity. Now notice that it is CBN that is struggling to do all this because we have failure in capital importation. In 2018, capital importation was $17 billion. 2019, it was $25 billion. Now, we'll be lucky if we end up in $10 billion in 2020. And they are failing. That capital importation regime is failing us. So we can't depend on imported capital for FDI or transport because they are going down. The last year, we had $5.8 billion in the first quarter of last year. Then it dropped to 1.5. It dropped to 1.4 in the third quarter. Now we probably will end up at 10 billion. But that has not. And let me tell you more.
All right.
The biggest constraint facing manufacturers, because that's where we're heading, to get more, to breathe more life into that. The biggest challenge facing them is power. Now, what they have now done, CBN says, okay, since we can't wait forever for foreign direct investment here, I'm going to commit more resources to build the GDP of the power sector by 7.5 trillion. And that means taking power to the mass market, having solar energy grids,
okay,
mini
Professor.
grids and off-grids. So that is moving. Then in March last year, a very important meeting. Important meeting last year was by the private sector. Agreeing that they are going to have infrastructure PLC.
Professor, if you can hear me, I think you just have to hold your thoughts there. We'll come back to you. We'll continue with this conversation. We'll have to take a quick break. Well, Professor Ken Ife is still with us. We'll be back in a moment. Thank you for staying tuned, and you're still watching Business Morning on Channels Television. And we'll still have with us Professor Ken Ife, a development economist. Professor, thank you very much for staying on. Well, I want to start this session now with what you talked about in agricultural sector. Now, I have looked at the data released from the National Bureau of Statistics, and it is quite revealing. If we can see that the evidence is contrary to the conclusions that are being published. Let me elaborate here. There has been an increase in the level of intervention lending and anchor borrowers program throughout 2020. Well, you noted that, but the output in agric has consistently falling every quarter. Look at that. Agric output in the first quarter, 2.20%. Second quarter, 1.58%. Third quarter, 1.39%. Therefore, it looks like the higher the intervention, the lower the output. Now, you mentioned some of the issues that you talked about. Flooding, you talked about ECOWAS-free movement, and some other issues. I know we also have the issue of the insecurity and all of that. But are these the reasons for these contradictions between data and the rhetorics, or is it a case of no synergy between the Monetary Policy Authority and the Fiscal Authority?
Well, you know, you need both. You need both fiscal and monetary policies to work together, and they have actually been working together, to the best of my knowledge. And but you need to bear in mind that CBN is not supposed to be the only one investing in agriculture. The whole purpose of CBN's intervention was to correct market failure. And then why it is putting a lot of its faith in pushing the banking sector to lend to the real sector and de-risking agriculture is to make sure, okay, look, if 1 million, okay, about 4 million farmers on 1 man, 1 hectare have actually benefited from funds from CBN on the basis of their BVN, biometric verification number, and then the satellite coordinates of their 1 hectare. And that's never happened before. But we have over 4 million of them, with, in 4 million hectares, much more than that, coming into not only transiting from the subsistence agriculture, but into modern commercial agriculture, because they are in a anchor borrowers network in which they are driven by anchors. Those anchors could be processors, aggregators, or exporters, or retail chains. And then they're providing them with the input service, giving them grains, supporting them all the way from mechanization all the way to export and to domestic market. So it's a very, very integrated transformation. Now, it's doing this. I cannot rely on CBN alone to do this. The whole market have to come in. In other words, look, if 4 million of the 44 million MSMEs are involved in this program, what's going to happen to that 40 million? The other 40 million should go to the market, which is the banking, financial services, and borrow money. So the CBN gives example. CBN had to start enterprise program to show that this can work. Other states have to take it on. It has to do what is not the only business CBN has to do, but is leading by example, trying to address the issue of market failure and show example and do all necessary things, increasing the risking from to 50%, possibly to 75%. So it's unfair to say that what is given should immediately translate to, when it is only a proportion of the market that is actually accessing the intervention fund. So let's take the question the other way. How much are the banks sending in to the lending to the private sector in agriculture? That's the much more correct question. And remember that the survey done by IFC some years ago, 2008, showed only 7.5% of banks lending going to private sector. Then 2012, it dropped to 0.4%. This year, this now is now in double digit. But this is where we should be directing our attention to make the correct link.
So
and then, of course, you know what is going on with the food. I've tried to paint the picture of what really goes on in the area of food. Now, if we want to correct this, don't forget, one thing is to produce food. The other thing is the journey of food, which I have told you. It goes all over the place. It goes to Benin. We're surrounded by Francophone countries. And don't forget, they themselves too, because of the differential in currency, they maintain an artificial currency, the CFA. Our own is real currency rates. So at the moment, they seem to be enjoying somewhat like a 50% differential in the rate. So our food is very, very cheap to them. Unfortunately, we are not getting any dollar from exporting this because they're using Naira in those border area. But when we go strongly on value addition and then process, then we have the capacity to earn foreign exchange, to reduce the pressure on foreign exchange. We have the capacity to charge them duty at the border unless they register for ECOWAS trade liberalization scheme and declare their due of origin and all the requirements before they can have a waiver on those. So it is a reality. So this investment is so critical to make sure that we take the whole chain and not just the food production. That's very important to make the correct analogy.
Okay, Professor, so the CBN on numerous occasions has reiterated its stance that inflation above 12% is growth retarding. Today we're seeing interest rates of less than 1%, inflation above 15%. Is it possible to achieve the anticipated recovery in this situation of stagflation with interest rate and inflation differential, which is a gaping negative? Will investors enter the market in this circumstance?
Well, it's very tough for foreign investors because the foreign investors, some of them, especially the portfolio investors, foreign portfolio investors are always looking at high interest rates, because they borrow money from low interest constituencies and come here and get very. But of course, the situation has changed. You've seen our treasury bill, which is good market for them, drop down to less than 1%. Now, the thing is, what more can you do? The question is, what more can you do? But the basic desire of the bank is to come down to 6 to 9%. And they've actually hit that very lately. But if you look at the core inflation itself, core inflation is around 11%. The core inflation has been on single digit for over 3 years. Just only recently that it climbed up to 10 and now is 11. So if you exclude, and that core inflation is where you exclude food and food sub-basket index, and you can see how much distortion food is causing. But it's not just the only thing, as I said. So whilst we are tackling with the issue caused by food and pouring resources there, we need to get all the other actors, the private banks and the other financial institutions to join so that we can reach a bigger critical mass of the remaining 40 million who are not even accessing the resources. That's one. And then we have to act on processing. Processing gives us the jobs. Processing makes our products here compete with those that are imported, reducing pressure on foreign exchange. Processing can earn us money from even the continental free trade. Are we going to export raw material to South Africa? Is that what are we going to do in AFCTA now? We're going to carry our raw food and take it to Kenya. That's not going to be possible. But while we are dealing with our existing neighbors who have so much differential and incentive to buy our raw material, the raw food, but it's not going to be an end game for us. So our end game has to go to world level processing. So that, look, you can't carry cassava. Cassava 3 days is gone. Once 70% is water. So we've got to have our strategic reserves, we have to put them to work. Get private sector to run them so that they can process anything that they can find and put in the strategic reserves. So that begins the first step of making sure that aggregators and those can provide the needed raw material for industries. Because some of them invest and say, but where's the raw material? Where's the raw material? Transport cost is so high. 20% of input cost is transport. So if you want to move 1 ton of soya beans from Katsina to Lagos, it goes from $100,000 to $200,000 because 75,000 naira is the cost of moving just one ton from that distance. But when we have a distributed processing strategy, linking it to our strategic reserves and getting private sector to drive this, this is the whole essence of how CBN is seeing this whole thing. But all actors have to be involved so that we can process at the point of production and then reduce the carrying of water and then preserve it. The good news is that Nigeria is the biggest producer of food in Africa. We are one of the 5 countries in the world, according to FAO, that produces more food than we require. But 30 to 70% of it can't make it into the food chain. So we still have food losses to contend with, apart from what the conflict does to us, apart from what our neighbors are doing with our raw food. So we have to look at all that. But having said that, investing in industry, linking it to production, and making sure that we can effectively implement the import substitution strategy and backward integration strategy is so critical. It's really, really critical. And the real sector must be well funded by not just CBN, but the whole of the private banking network. They have to do that for us to actually have a serious chance of taming this inflation.
Well, the policies, of course, have to be right. Yes, Professor, I agree.
But there are other perspectives on inflation.
Professor Ife, I agree with you, but of course the policies have to be right to enable the banks to actually do the proper lending. But we'll come back to that, you know. But I still want to take you on this inflation issue because the central bank is often perceived to have this view that inflation in Nigeria is not as a result of money supply growth, but let us again share the data. We have a look at the money supply growth there versus inflation. First quarter of 2020, 7.75%. That's money supply. You have inflation 12.2%. In the second quarter, money supply 13.24%. Inflation 12.43%. In the third quarter, 21.51%. That's for money supply growth. And then inflation 13.25%. Of course, the fourth quarter is there. 26.82%. Of course, inflation, when you look at it cumulatively there, is 14.96%. Now, it shows clearly that as money supply increases, inflation also spikes. Do you not think that it is time to bring money supply growth under control by increasing interest rates, perhaps, and controlling the level of federal government debt funded by the CBN, which, according to Fitch, is stoking inflation to unacceptable levels?
No, I don't agree. When it's not a linear relationship, those figures you put out there are not a linear relationship. If it was 7% in the first quarter of 2020, then it increased threefold. Then you should have seen the inflation increase threefold. Then in the second quarter, when it was 12, then you would have seen the inflation increase double compared to it's not a linear relationship. And by all means, it's not the only factor. The interest rate is not the only factor connecting money supply to inflation. Let me explain something to you. We have to be very cautious in the way we expect monetary policy to do magic. Because one, a lot of money are outside the banking system. Two, you now have more money in the private sector that, as you saw, we are helping boost the capital market. And I have not seen any evidence that all that money that is rushing into the capital market is actually going into productive activity and productive capacity to increase. And if it doesn't, what we are doing is that we are creating a bubble. We are simply inflating the value of the stock market. And that bubble will burst sooner than later. Look at what happened to us in 2008. And it's a totally different matter, and 6 trillion is on the witness stand on that. So now, what you see is that I've lost your service. Oh, okay. All right.
Okay.
So it's not a linear relationship. So what you need to do in that particular case is to look at what the bank is doing. Now, if you just say reduce interest rate, increase minimum monetary policy rate, how much more, how effective do you think it would be in the current situation where you have so much outside the banking sector, you have so much liquidity in the private sector? Now, this will only be effective if the banks are lending. The fact of the matter is that the banks are not lending. So if the banks are lending as much, then if you tinker with that rate,
Professor,
then
but
it could affect what the bank. But it's not lending. The bank is not lending as much. If it is lending, it's not lending to the correct sector, which is the agri sector. In this particular respect, showing what inflation is. So it is not. So it is all the forceful intervention from the CBN and all the that is what is even keeping it. And don't forget again, our population growth rate is double the rate you are showing me on agriculture. We are 3.2% population growth rate. Urbanization growth rate is 4.6%. And that's why your urban inflation sub-index is even higher than the CPI. And of course, always higher than the rural sub-index. So it is not as simple as those figures you just displayed to me. It's a far more complex story, especially when you have a recession and lockdown that has hit other sectors. And then you have other things in the other culprits like power, and then you have transportation network. I'm glad government is now going into rail to make sure that, because the road thing is just is a no-brainer. So now that you have more actions going in to reduce the pressure on the output, then you could see some results. But it's very difficult to think that money. And in fact, if you do what you just suggested to me, to raise interest rate, I don't think you're going to solve any problem right now. The best that they can do is just to hold it or move it down slightly, just to give some signal to the banking community to try and bring down their prime lending rate to single digit.
Okay, Professor, a quick one before I let you go. Let's look at it vis-a-vis other countries. If you look at Nigeria's peer countries, we have Ghana, we have South Africa, we have Kenya. Now, it is quite clear that in all of these countries, the rates of interest on treasury bills are higher than the inflation rate. And in fact, South Africa reported the lowest rate in inflation in 16 years. That was last week, Thursday, at 3.3%. Now, are there any lessons to be learned from these real-life examples, especially when the difference between headline inflation at 15.75 and treasury bill interest rates for 90 days is 0.5%? Where then is the incentive to save? When we look at Nigeria's savings to GDP ratio is 12%. So if I cannot save, then I am forced to keep buying, and that, hikes up inflation. Don't you think so?
Well, there is a point in that argument, because in the end of the day, when you save and you want to invest, you go and take your savings. It's only when you don't have savings, as in the case of our government, that we have to resort to borrowing, and particularly the external borrowing. It's all because we don't have national savings. And the government is now working on national savings schemes, and as you know, and you've also seen how they're looking to take money from the treasury, not treasury, sorry, the pension fund. And then, of course, the new 2020 bill, finance bill, says, good, set up a fund and get all this, the unclaimed dividend and all the dormant account money, put it in there. And then, of course, government can borrow against those, and it's all denominated in Naira. And the same thing with the infrastructure company looking to capitalize 15 trillion, all in Naira, to take over this whole burden of 26 big national infrastructure from government. Professor. And then let the private sector massage this and work with this. Professor. So all of these are actually going to address the problem that bring us under the orbit where you can see policy. Policy make a link that you are describing. Now, also, don't forget, when you talk about South Africa, how much look at the diversification index of South Africa and other countries. You look at the diversification, industrial output gives them a lot of foreign exchange. Mining gives them a lot of foreign exchange. So they have they're diversified, very, very diversified, and they export 40% of the vegetables and fruits eaten by Japan is from South Africa. There's a well-diversified economy. For Nigeria, it's not. With 90% of our forex comes from oil. Once crude oil is under attack and we have no control over the price mechanism, everything starts rolling. That crisis will begin. Because look at the demand. Demand for forex is about 3 times what we are getting. So the pressure comes from there. And obviously, the pressure means the pressure on foreign exchange, and then also you have imported inflation that comes with it. You cannot stop the traders. The traders will go to black market and get their money, import it, and then go and sell it at frivolous rates. And all of them are inflation. They increase inflation. Inflation is not just agriculture. They are composite indices. They have so many, petrol, all sorts of prices. Now look at the petrol. Why would Nigeria the country that produces the greatest crude in Africa is still the highest importer of refined product. Why are you not refining that product? And then look at the pressure on foreign exchange to import these products. Not even to talk. We're not talking about subsidy. All of them are impacting. They're all impacting.
Professor, well, at this point, I really don't envy the central bank governor. Well, the meeting will be concluded tomorrow, and the decision will be announced. There's one to watch. Let's see what eventually happens. It's the first one for the year, but let's just hope everything, the right policies are put out there. Thank you very much for your time, Professor Ken Ife.
Thank you for staying with us. Well, it looks heavy on the mergers and acquisition market in London this morning. Let's check with Juliana what's going on. Hello, Juliana. Good morning.
Hi, Laddie. Good morning.
Good morning. So, internet fashion retailer Boohoo has reportedly agreed to buy the online business of Debenhams in a move which will see the department store chain close its remaining high street shops. What are you hearing about this?
Well, this is a great news story for Boohoo. As you said, they're an online fast fashion retailer. And I think here in the UK, definitely over the past couple of years, it's these online fashion brands that have, gained superiority over retailers. They've got and captured that 16 to 24-year-old market, people that are happy to spend their money on these throwaway clothes. And they have got a cut price deal. They have bought the 242-year-old Debenhams store for £55 million. Now, a lot of economists are saying that's a really cheap deal, especially if you think of the amount of stock and produce that Debenhams have, which is the prestigious luxury beauty market. And up until now, Boohoo haven't managed to get into that store. So they have bought Debenhams, which does mean that, unfortunately, this sees the loss of 10,000 jobs. Boohoo have released a statement, and they do say, because, of course, they are going to put it online, that perhaps there could be an opportunity for some staff to transfer over into Boohoo. But we're looking at likely to be a handful. This is another story of a stalwart retailer here in the UK, Debenhams. They were having problems before the pandemic. They went into administration in April. There were lots of talks about some sort of consortium trying to save them, but alas, that's not been the case. So in some ways, this is great news. Boohoo, their shares rose by 4% this morning. But if you think about it, a 242-year-old store, 144 stores and outlets across the UK, tens of thousands of jobs have gone. And yes, another one bites the dust, unfortunately.
Incredible. So, and ASOS has joined the race to buy Topshop, Topman and Miss Selfridge out of administration. However, the online retailer only wants to buy the brands and not their shops. What does this mean?
Well, it's exactly the same thing as if we're seeing with Boohoo. ASOS is another online fashion retailer. They were, the number one. They've been picked to the post by Boohoo and Pretty Little Thing over the past couple of years. But they're interested. They're interested in Topshop and Topman. I think if you have a look at the Arcadia Group, which again went into administration in November, very similar story to Debenhams. They were also struggling before the pandemic. But with the fact that clothing stores have been closed over the past year almost here in the UK, it's just been very, very difficult for them to retain their position. Last week we were discussing Next, one of a very few stores here in the UK that predominantly rely on people coming into their stores. They try to acquire the brand. They released a statement last Friday saying they just couldn't afford what Topshop and Topman were asking for. Now ASOS are hoping to get in with that. They already sell lots of Topshop and Topman brands on their website at the moment. No indication yet that this is pretty serious and it's gone very far. But, ASOS, considering what's happened with Boohoo today, they do remain a front runner. So we'll have to see later in the week whether or not, they can acquire this deal. But again, 13,000 jobs are at risk. Not a great start to the week for retail, especially considering we had those retail figures last week telling us that for the past 25 years, the last year's online retail wasn't great, absolutely whatsoever.
Okay, it's Monday morning. Lead us into the new week. What's on the radar aside from these deals?
Well, what everybody is going to be waiting for, I believe those numbers are coming out on Thursday, are those unemployment figures. Unemployment here in the UK currently stands at 4.9%. I think economists are pegging it to come in at about 5.6%, though the Bank of England Governor Andrew Bailey predicts it will be between about 6.5 and 7%. Really important because, of course, we're still in a lockdown, stores are closed, consumer confidence pretty low. So we're relying on these figures to not be that high, especially considering that furlough scheme is still being extended. The FTSE All-Share actually opened pretty much as flat as a pancake. It's the travel and leisure stocks that are falling because there's lots of media speculation that potentially the British borders could be closing. At the moment, anybody coming here into the UK has to self-isolate for 10 days, 5 days if you're willing to take a test and it comes out negative. But yes, there are concerns. And as we know, over the past couple of months, typically when the press get a story here in the UK, it is true, which is why the markets are going into a frenzy. British pound still on that pretty good rally, currently trading about 0.21% against the dollar. But it is the beginning of the week, and of course it's COVID, isn't it? So anything can happen at any time. So we'll have a complete full update for you at Intraday,
All right.
Daddy.
I guess we'll see how it goes. Thanks for the update, Juliana. Do enjoy the rest of your day.
Thank you.
All right, let's head over to the markets. Eddie, what's up? Good morning.
The market turned bearish as profit-taking activities dominated the market throughout the week, apart from Wednesday where we saw some gains. But what should we be expecting from the market this week? Let's talk to Charles Fakuga, the CEO at Super Commercial Trust Limited, for more. Good morning, Mr. Fakuga. Thank you for joining us on the program.
Good morning. Thank you for having me.
Well, as the first MPC meeting, starts today, today and tomorrow, what should we be expecting from investors this week?
Yes, right now the market has opened and the market is a little bit quiet. Traders and investors are cautious. Everybody is waiting to see the outcome of the MPC meeting. But I think we should expect so much from the MPC meeting. I believe that the parameters are going to be left the way they are because it's just the beginning of the year. So, and of course, you know that any decision that is being taken that will affect the rate is going to have an impact on the equities market. So traders are cautious. Investors are also cautious as we await the outcome of the MPC meeting today and tomorrow.
As Mr. Fakuga, thank you for your input on the program. Do enjoy the rest of the day. Well, we'll just continue with the market now. The all-share index was down 0.42% week on week, and that brought the month-to-date and year-to-date returns to about 1.8% at 41,001.99 points, while the equity cap was at 21.499 trillion naira. Activity was mixed. We saw higher volume last week at 4.28 billion units worth 25.98 billion naira, all traded in 32,849 deals. All the sectors we track were negative last week. The banking index is down 1.33%. We saw a lot of profit taking on tier one lenders, Zenith Bank, GT Bank, Access, UBA, and the likes. Consumer goods was down 0.09%. Industrial goods was down 0.51%. We saw, some profit taking on Dangote Cement and Boa Cement last week. Insurance was down 0.80%, while oil and gas declined 0.13%. The unlisted securities market was positive by 0.91% at 740.45 points, while the market cap was at 530.99 billion naira. We saw 12.37 million units worth 131.90 million naira traded in 37 deals. Now, the fixed income market, the bond market was, mostly focused on the bond auction that we had last week by the DMO. So we didn't see a lot of activity there, although there was some profit taking in that segment of the market. We saw average yields expand by 38 basis points week on week. So we saw yields increase in that space. On Friday, there were 27 deals worth 10.91 billion naira. The Nigerian Treasury bills market was also a bit quiet last week. The low yield environment, investors are still waiting to see what's going to happen. There's an auction this week as well, so we'll be seeing what happens there. But let's talk to Apewe Oputu, a fixed income dealer. Okay, I hear she's not with us on the show, but on Friday we had 6 deals worth 2.50 billion naira in that segment of the market. And the Omo market was also bearish last week with 13 deals on Friday worth 10.22 billion naira. Well, that's it on the market review. You know, all eyes are on the MPC meeting. So we see investors just holding on and waiting to see what direction the MPC goes, Chimi.
Yeah, a wait and see mode there. And tomorrow at 2 p.m. or thereabout, the central bank governor will be, of course, having a press briefing on the outcome of this meeting. And, of course, we'll be airing this live starting from 1:30 p.m. tomorrow. And then we'll have our guests here to analyze some of the issues as relates to monetary policy. So keep a date with us tomorrow at 1:30 p.m. Laddie?
Yeah.
Okay.
You care about the crypto market today?
Oh, well, do you have any? No, we don't have much time.
No time.
All right. That's it on the program. Thank you for watching. I'm Chimeze Obi Iwagu.
Thanks for watching. I'm Laddie William.